Good morning, ladies and gentlemen. After the 1 week break that I had in New York, we can review the price action of last week, and we can see that the bonds are yo-yoing away just like before the break. We have 1 week up, followed by 1 week down, and we are basically trading in the 2-year note between 108.08 and 108.17, and breaks either side are just not sustained. What can we deduce from the 2-year note? We can deduce that the market is now looking for a rate hike. What can we deduce from the 5-year note? The yields have now broken the triangle. This is a typical fourth wave consolidation triangle, whereby this was the first wave followed by the third wave, and now we're in a fourth wave consolidation which should break out to new highs. This has been our view from the beginning. It was just a question of how far the fourth wave triangle would go down before the fifth wave. Well, it is pretty obvious now that we might have a retracement back down towards this kind of yield, 193 or 190, before we break the 212 level and probably go to 220, 225. The 10-year note, if we look at it in the IEF, it is basically trading between 104 and 106, and the 10-year note yield is being caught by this downtrend line, which comes in exactly at 249. It is pretty evident that the safest trade is to be short of the 2-year and the 5-year and long of the 10-year. So since the 10-year note has not broken above the 249, 250 level, it is hard to be short of all the contracts. It is much safer to have a short of the FV and TU as opposed to long of the TY on board. But we still think that the direction of all these yields is higher, and that we will see new high levels of yields in the weeks ahead. This yo-yoing in yields is evident in Europe as well. Every time the market, and this is the bubble, every time the market comes down to the Bollinger Bands, it rejects and moves higher. So what can we say? We can say that we are in a range between -60 and -30, just like in the States. This gives us an indication that we are unlikely to break the range in the euro against the dollar for the time being, until we see a sustained break in the yields in Europe or in the US. At the moment, they're just yo-yoing in parallel in a 30 to 40 basis points range, up and down, and without a trend. This, however, is a multi-month consolidation range, which at some stage will break out significantly higher, and we will go to at least zero, if not positive yields in the 5-year note in Germany. That seems to be obvious, and in a couple of years' time we will be kicking ourselves and saying, how could we not possibly spot this as a huge trend change moment? The same thing is obvious if we look at the 30 and the 10-year note, the Bund. If we look at the weekly, we can add the Bollinger Bands. We can see that the moving averages have all turned upwards, that we are trading between 50 basis points on the upside and single figures, call it 10 basis points on the downside. But we feel that there is a definite change in trend here taking place, which will take yields back up to at least 90 to 100 points within weeks. So we could say that we are very close, if not already at the point where it's time to sell European bonds and buy European equities for a sustained move higher. The equities complex had a very interesting week. The Trump speech did the trick, and the ES traded up towards 2400, where it failed. What is our view? Our view is that this was the exhaustion of a third wave higher, whereby we've had all the way from the lows. This is the fifth wave. We've had an A, B, C retracement. We have the first wave, which basically ended here at 2115, with a second wave retracement back down to 2000. We've now had a complex third wave, which needs a retracement. The retracement would be probably around the 2300 to 2340 area, followed by one last wave up, which takes it up towards the 2500 area. We are definitely in an area of danger here, because if we break the moving averages on a closing basis, which now are very close to the market, are around 2378, we will have no support until 2345. This could be the move next week, back down towards 2345, maybe back down even to 2315. It could be very quick, it could be very violent, before we have this new buy area, which should take us back up to new highs towards the 2500 area eventually. This view of the US equities is actually confirmed by a very interesting chart of XIV. It has now completed the third wave. It is doing an ABC retracement. We expect it now to come back down as the market corrects in the States, to come back down towards below 60 in an ABC pattern before it shoots higher and trades over 70 in the last leg before a complete collapse back down towards 20. That is our very firmly held view, that we have one more move up in these indices before a complete collapse, and we are quite sure that we will trade at 20 again towards the latter part of this year. The one equity market with momentum is now stocks. It was held around the 3325 area for several weeks and is now gapped up and closed on its highs. It is obvious that we will trade in the next week or so at least at 3488, so that is a good 2% higher than we closed, before retracing and being caught by the 3325 for a few weeks before we break substantially higher and try and take out this level at 3826. The market is now anticipating a positive resolution to the French and Dutch and Italian elections, and will probably rally into them very hard over the course of the next 2 or 3 months. It is patently obvious that the one market with momentum is the stocks, while the one market that we think is losing momentum is the US equities market. Therefore, being long of being long of stocks and short of ES becomes a favored trade as of this moment. This is a chart of the transportation average in the Dow, and you can see that from the low that it made in '09, it has made a beautiful 5 waves up, having led the Dow Industrials in every sector of in every part of the time frame. It has always led the market up, and it has led it down. It topped out far earlier than the Dow Industrials did, and then it bottomed far earlier than the Dow Industrials bottomed and turned higher. We're now in the last wave. As you can see, this is one wave, 2, 3, 4, 5. We are now in the last wave of the uptrend. Have we topped? We can't tell. What we can tell is that we are in the absolute last gasp stages of this index going up before it turns down and retraces at least 0.382 of this whole move up. Just to give you an idea about how large that retracement could be, we are talking about a move, if that were to be the high, we're talking about a move which takes it to at least 6,700. So that is something in the order of ES coming back and retesting this downtrend line around 1800, 1810. This is what makes us so cautious about US stocks here as opposed to the European stocks. The Russell 2000, just like the transportation index, is beginning to flash some very important warning signals. It led the move up in the ES. It retraced before the ES. It did a beautiful 5 wave up. It did a beautiful ABC on the way down, and now is in the throes of the last wave higher. It is substantially underperforming ES, and therefore giving warning signals that we are near exhaustion levels. We don't doubt that we are within 5 to 7.5% of the high in ES and TF and the transportation average. This makes it the harder part of the wave to trade, because any and all downdrafts are going to be recovered very quickly as sentiment changes from negative to positive. This is the last part, which is most sentiment driven as opposed to fundamentals driven. We now have a battle between the people who say things are not the same as they always were, and the other people who say yes, we are in exactly the same part of the cycle as we always have been. It's just that we are now even more overbought. This is where the real battle between the bulls and the bears is taking place, and we are quite sure that it will resolve itself to the bear side. It just depends from what level. Fundamentally, there is absolutely no question that we are at unsustainable levels. We are now at 18 times forward earnings. and these are expected forward earnings, which are always 10 to 15% above real forward earnings. So in real terms, we are probably trading somewhere around 20 times real earnings. It is very hard to see how the market can keep up and stay at these levels without being shown by Trump what the results of his actions are going to be. If he does not deliver, the move down is going to be so violent that we just shudder to think about it. It will be definitely to somewhere around 1800 in the next few months. If he does not deliver on huge tax cuts, if he does not deliver on deregulation and everything else that he has promised, the move down is going to be so violent, it's going to make 1987 look like a picnic. We are quite sure it's going to happen. The only question is from what level it happens. We make absolutely no apologies for being long-term bearish in equities at the moment. This is a chart of the emerging markets. For the past couple of weeks, while the US market has been going higher and higher, it has been having lower closes. We think that this is a leader in terms of what the markets are doing worldwide. It anticipates a move down in the US markets over the next couple of weeks. We would like it to see it test the 3620, 3650 level, and then have one final move to above 40 in the next couple of months, which will coincide with a new high in the US markets to around the 2500 level in the final fifth wave of the fifth wave. And after that, all bets are off, and we could see even new lows in the emerging markets, where we watch a sustained move lower in the equity markets worldwide. We are pretty sure that we will have one more wave higher from the next low around 3650 before we have the possibility of a very much sustained move lower like we had in 2015 and even earlier in 2014. We make no apologies for being bearish here. It is not often, in fact it's only once a decade that you get a confluence of the fifth wave higher, and also the fundamentals being so far out of whack with the potential earnings that companies can produce, coupled with a move higher in yields, which could give you substantially higher bond yields with which to discount forward earnings. Once again, this is something that happens maybe once a decade, and that it's something that one has to take advantage of when the last wave has exhausted itself. As far as commodities, last week was a nothing week. All the commodity indices actually closed very much where they opened, but they are every day and every week showing potential by turning the moving averages higher and trading still above them. So they are still in consolidation, and we are watching like hawks for breaks of these levels: 438, 90.3 and 20.85 in these various indices for a sustained move higher, which should actually give you much higher yields eventually in the bonds. We don't know what is going to trigger it. We don't much care. we're just watching to see if these levels are broken, while below there one has to be still cautious of being short bonds at these levels. Finally, our biases for next week. FV for the 5-year and the 10-year. We're watching this coiling of the triangles in yields, prepared to go with a sustained break in either direction confirmed by both. The 10-year still has not confirmed the break, and the safest trade is to be short of FV, long of TY. Bunds and Bobble, they're doing exactly the same thing as the 5 and the 10-year, but they are entirely politically driven at the moment. We favor a normalization of the tensions in Europe, which would give us a much higher level of yields in both Bunds and Bobble, certainly compared to the US and to BTPs or OATs. But that could be a long time away because we have the elections starting in May, so we are many months away. But we think the market will anticipate it. We're still watching the commodities indices. They haven't moved. Now, the ES, the third wave, should be exhausted. The retracement objectives are 2340 to 2320. Put spreads are definitely the best way to trade that. Say 2380, 2390 puts being long of those against short 2330s. If you can pick them up for as you were able to last week at the levels we suggest, that is a very good trade because it gives you a risk reward of 5 to 6 to 1. So hopefully that is the best way to trade what should be a fourth wave retracement before a final fifth wave blowout to the upside. NQ at the moment we're neutral. XLK is in a very precarious position. We are neutral compared to ES. We are no longer bullish NQ compared to ES. We think the retracement could be much more violent in NQ than in ES. The Russell 2000 is the one which is not confirming, even though it should be the preferred long-term instrument. So we are saying here that a close below 1490, 1390, that it should be, close below 1390 to 1385 would indicate that we have started the retracement phase in all US equities. And a close below 1346 would actually give you probably that we have topped in the Russell 2000, that we've actually made the last run in the Russell 2000, which could give you the start of a complete retracement in all US equities if it is confirmed by the Dow transport indices. European equities definitely have broken out, and any moves back to 33.25 are opportunities to go long of them, certainly against US stocks or maybe even emerging market stocks. The next big trade, short bubble, long stocks, could be here already, and we will be watching it very closely next week. We certainly think that that could be a major trade for the rest of the year. Emerging markets could be the leader to the downside, with 36.50 to 36.20 as your buy targets before the next wave higher. We will be definitely watching to buy at those levels. And one final caveat here. Dow transports could have topped already and could be the tell in this market. We will be following closely what the Dow transports do. It is very, very important because the Dow transports probably top out months before the Dow Industrials, and are always the best tell that we have completed a long-term sequence. We'll be watching it very closely and tweeting away. Thank you very much indeed. See you on Monday.